we'll get started. Oh, and so we will have questions after each lesson, because I'm going to do the 4 different types of self-employed income, and I'm actually going to run through each different type and calculate it with you guys watching. And so after each type, I will allow questions in case you think of something while I'm going through. Okay? So we're going to do the 4 different types of self-employed income. We're going to calculate it, and then after that, we're going to review profit and loss statements so you can see what we look for on the statements, and then also the business bank statements. Now that that's a COVID overlay, I'll show you also what we look for when we're reviewing income. So this is the outline. At the very end, I will do a quick FHA and VA requirement, just so you know the difference between the conventional and FHA and VA. How you calculate the income is the same though. So when I'm calculating this, this goes for conventional, FHA, VA, and all that. It's just the documentation requirements are a little bit different for FHA and VA. So that's what we'll go over at the end. All right, so Schedule C. First, we'll do the normal required documentation, 2 years personal returns. A lot of you know that you can possibly go down to 1 year depending on the AUS. So with Fannie, you have to check the AUS to see if it says 1 year is allowed. With Freddie, it'll automatically say you can use 1 year, but you have to prove that they've been self-employed for 5 years in order to use 1 year. With Schedule C, it's kind of hard to do that. So if you have Schedule C, you have to get something like business license showing how long the business has been open in order to do 1 year with Freddie. So depending on your AUS will depend on if you need the 2 years tax transcripts or just the 1 year tax transcripts if you only need 1 year. The year-to-date P&L has to be within 60 days of the note date. And the 3 months business bank statements also have to be within 60 days, and they have to correspond with the P&L. So if the P&L ends October, you need August, September, and October business bank statements. So they have to go together. The picture over there, so this is just it's your individual tax return, and then down here it's going to show the Schedule C income on the next page of the personal return. And then when you actually go to Schedule C, you'll see what we look at when calculating the income. So how I did this presentation was, we're going to send this out to everybody, and all my arrows are color coordinated, so if you are calculating an income, you can go to that specific income type that you're calculating and follow my arrows and hopefully do it yourself following the arrows, and hopefully it'll be pretty easy for you. But what you have to look for is pretty easy. So what Dan handed out to you guys is just the income calc worksheet that I use. This is actually through Genworth. You can use any income calc that you like. A lot of the MI companies have really great ones. This is the one that I find is very easy to follow, and it has all the different types of self-employed income on it. So what you would do is, that's just online, and I can send the link to anybody if they like it. But you can see what I'm looking here. So over here, this is the income part that we're going to fill in. And so on the form that you have, you can see where this little screenshot is from. You want to follow along. But really all self-employed income is following these prompts that it tells you to. It tells you what line to look for and what you can add back and what you have to deduct from the income that we're using. So for instance, if you see this little line here, this is a plus or minus because it depends on if it's a negative or a positive on return. If it's a positive, that means you get to add back this to the income. If it's a negative, that means you have to deduct it from the income. And then at the bottom, it'll show you the actual result. So when you have one of these, it's very easy to follow if you just follow line by line what it's telling you to do. So for instance, right here, first one, net profit or loss, it tells you line 31. So then you go down to line 31 down here, and it's 153 and it's positive. So I enter in 153. The other things to look for, you just keep going down. Now this one was a very simple self-employed, so they didn't have anything that I could add back, but it just tells you what you can or can't add back. Now this one, non-recurring other income or loss, line 6, there's usually never anything there, and the only time you can add anything back there or deduct is if you can prove that whatever's listed there is non-recurring, which is very rare. So you usually should never have to fill that actual spot out. But then you go to the next one, and it's depletion. Line 12. You see over here my arrow, depletion, there's nothing there. So we go to the next one. Depreciation, line 13. There's nothing in line 13. So you can move on. Meals and entertainment. This is something that you have to deduct from the income. It's right here, it says 24B, so you just go to 24B, meals and entertainment, and there's nothing there. And then the next one is on the second page, so Schedule C, there are 2 pages for you to look at. So here's the next page. So then we go with business miles, page 2, part 4, line 44A. So page 2, part 4, line 44A, you can put this mileage back in and it calculates the depreciational value for you. And then amortization and casualty loss, you only can add that back in if it literally lists under here, under expenses, amortization, casualty loss, and it's not listed there, so there's nothing to add back. So then, that's it for Schedule C. Let's say our AUS was 1 year. You divide it by the number of months, 1 year, 12 months, 2 years, 24 months, and so for this borrower, their monthly income for this specific Schedule C was $34.33. Schedule C will be the easiest one that you have to do. The least amount of documentation to review. Now again, you would do P&Ls and business bank statements, but we're just calculating the income now, and we'll do a P&L and business bank statement example later. So does anybody have any questions on Schedule C income specifically? All right, so the next one is partnership or 1065. How you can tell what you're looking at is just the number on the tax return. This is the business return. So this is a 1065, and again, for this, you're going to need 2 years personal returns, 2 years business returns, 2 years K-1s, and 2 years W-2s if the business returns report W-2 income on them. And again, tax transcripts go with that. So again, if you're doing Fannie and it says you can do 1 year, then all of this would only be 1 year. With Freddie, if they have proof of 5 year being employed, self-employed for 5 years, then you can do 1 year. And what's great with self-employed, or with like partnership and 1120S, is the tax return tells you when the business started right here. So I go off of this when determining for Freddie if they've been in business for 5 years. So if this date is 5 years old, then there's nothing else that I would need to prove that they've been in business for 5 years. Okay? And then the same with the P&L, 3 months business bank statements have to be within 60 days of the note date. All right, so now we're going to calculate the income on here. It's the same as Schedule C, where you just follow the prompts. And there's 2 different sections you have to fill out. And you just make sure on that form that we handed out that it says Form 1065, so you know you're filling out the correct one. Because with 1065, 1120S, and 1120, they are all numbered differently. So if you're filling out the wrong form, you might be filling out the wrong numbers. So this is the 1065. Follow the prompts. Pass through income or loss from partnerships, line 4. There's nothing there. Non-recurring other income, so this is lines 5, 6, and 7. Now again, there is stuff here, but I would have to prove that they're non-recurring. And usually we can't tell that based on the return, so I don't add these back or deduct anything with these 2 lines. Depreciation, line 16A. You go down to depreciation, line 16A, and that's where I'm getting this number, so we get to add that number back in because it's a positive number here. And then depletion, line 17. Line 17, and there's nothing there. And then on the next one, this is on the next slide, in the next pages. So with business returns, they look like a lot, but there's only a few pages that you would actually need to review when reviewing the income. So now we're going to go down to amortization and casualty loss. It says it was line 20. But that's only if amortization is specifically noted, which I'll show you on a different page where it would be noted. Then you look for mortgages and notes payable in less than 1 year, and it tells you Schedule L, line 16. So you go here, this is Schedule L. You go down to line 16, and then D. Where this little arrow is, there's nothing there, so there's nothing that we have to deduct. If they have these, we have to deduct them from the income. All right, so, and then travel and entertainment exclusion, line M1, line 4. Here's the M1, line 4B. This number right here is where I'm getting that from. 2288. And you see how it's red over here? It's because it's a minus. That means we have to deduct this from the income. All right, you also have to make sure that you review the federal statements at the end. This is where it's going to tell you of all the deductions that they've claimed if there's any amortization. So you literally just go through here and see if they've claimed amortization, which they did at the bottom. It's 549. And that's where you can add that back in. If they don't have amortization listed, you can't add back in any of these. Okay, then you're going to review Schedule K1 for the 1065. So this is something that a lot of people don't know or they miss. With Fannie and Freddie, they have different requirements when it comes to reviewing the K1. So with Fannie, you have to look at line 1, which is up here. It's saying that they have $47,274 in income for that year. But then they also want you to look down here under distributions, $9,900. This is the actual amount of distributions that he paid himself for this year. Fannie requires we use the lower of the two. So you can see a big difference here. If you just use this number up top and they have a lower number of distributions, they're not going to qualify if you were using the higher number. Freddie doesn't have this requirement, so you only have to do this with Fannie. Now there is a type of calculation an underwriter could do to try and prove that they did in fact have enough money to use this higher amount, but as an LO, if you can use a lower amount, that's what I would just do every time just to make sure you qualify. And then if they don't, you could reach out and we could tell you if you can use the higher amount based on our calculation. Okay? So in adding this into our income up here, it tells you right on the income calc form, ordinary income or loss from line 1, there's a little star and it says review line 19 for distribution. It's telling you you have to use the lower of the two. So let's say we're doing Fannie and we're going to do 9,900. So that's where I get the 9,900 from for this income calc. And then you also do the net rental income, lines 2 and 3. There's nothing there. And guaranteed payments to partner, line 4C. That's right there. You get 36,056. If there is a negative number in any of these, you do have to hit them with it. You can't just leave it out. And then lastly, down here is where you find the percentage of ownership the borrower has. Now, most of you know 25% or more is considered self-employed. This borrower is technically not considered self-employed, but this was just a good example that I could show you. So even though he's only 22% owner, you still can calculate things this way if you want to. And you put the 22% ownership down here because what this section does is since he's only 22% owner, he only gets credit for 22% of these deductions that we're adding back and taking away. That's why I do that. So now we're going to do 2019. It's the same exact thing. Go through, nothing on line 4, nothing on line 5, 6, and 7. Looking over here. And then depreciation, line 16A. There it is right there. You get to add that back. Depletion, line 17. There's nothing there. Amortization casualty loss. It says line 20, but again, that is a bunch of different expenses. You have to go to the federal statements to see if amortization is listed in order to add that back. So now we go to the next page, and we look for mortgages, notes payable in less than 1 year. It tells you to look Schedule L right here. Line 17, D, and they have it. So we're actually hitting them with this loss because they're saying that they have a note due within 1 year. We have to hit them with that, unless you can get something from the bank that states that that note will recurringly go year after year. Let's say that we didn't get that, so we're hitting them with that loss. And then travel and entertainment, line M1, 4B, which is right here, 4,037. And again, it's red because these two things we have to deduct from their income. All right, here are the federal statements. Again, we're going to go through and make sure to see if any amortization is listed, which it is, of 496, so we can add that back in right there. All right, now we're going to go back to the K1 for 2019. And remember, again, we have to use the lesser of the income and the distributions. So in 2019, he gave himself $9,900 again, but he's claiming a loss. Because this one is less, we have to hit him with the loss. Even though he gave himself $9,900, we have to go with the lesser of. So that loss, you see it's in parentheses, you have to make sure to put a negative when you put it into this form. And then guaranteed payments to partner, line 4C, that's where that's coming in from. And then again, he's 22% owner in 2019. Now this can change. In 2019, you could be 50% owner. In 2020, you could be 35. So you do have to make sure that you're looking for each one when we're doing this. So lastly, now we're going to calculate the income. In 2019, he had a loss, mainly due to the K-1 loss and the mortgages, notes, bonds payable in less than 1 year that we had to hit him with. And then in 2017, or 2020, you had positive 73,000. We're doing it over 2 years. So you add in the K-1 income plus the tax return income. That's how these numbers come out down here. And over 24 months, that's everything. Total income we can use for this borrower is $3,041, or 41 cents. Does anybody have any questions or want me to show you anything on the 1065? Okay. So that brings us to 1120S. It's very similar to the 1065. Again, 2 years personal returns, 2 years business returns, 2 years K-1s, 2 years W-2s if the business reports W-2 income, tax returns, etc. Again, for Fannie, you can run it to see if you only need 1 year. For Freddie, even though we blacked out this date, if this is over 5 years, then you can use this to see if they've been self-employed for 5 years. And again, year-to-date P&L and 3 months business bank statements that correspond with P&L. All right, so very similar. But again, you have to make sure up here that you're doing the S corporation cash flow, because again, these numbers are labeled differently because it's a different type of tax return. So you're going to go to non-recurring other income and loss, lines 4 and 5. There is something here, but you'd have to determine if this is non-recurring in order to subtract or add it back in. Then you'd have to go to depreciation, line 14. It's right here, 57,250, you get to add that back. Depletion, line 15, nothing there. Amortization casualty loss, that's line 19 on this one. Again, this large number is a bunch of deductions, so you have to go to the federal statements to see if it's listed there. And on to the next page for the rest of them. So now we're going to mortgages, notes, bonds payable less than 1 year. This one is listed as Schedule L, line 17D. Here, there's nothing there. And then travel and entertainment exclusion, Schedule M1, line 3B, 1791. And again, that's red because we have to hit it with that. All right, here's the federal statements. You look through all of these to see if amortization or casualty loss is listed, but it's not, so nothing out of this can be added back in. Now, this one actually has W-2 income. That's what this 1125E compensation of officers is for. So this one shows that there's actually 2 people that own the business. Obviously, you blacked out their names. But it'll tell you this is the W-2 income they claimed they gave themselves. So we're just going to pretend like this is our borrower, first one here. So that's where the W-2 income comes from, 112,035. The key here is that you actually have to get the W-2s to make sure this number matches, because sometimes they don't. Whichever one is less, that's the one that you have to use to qualify. Okay? And then we go to the K-1s. Very similar and same concept. So it tells you here, ordinary income or loss, line 1 star, review line 16D for distribution. So he's claimed that he made $322,262 in income, but he only paid himself $130,191. We have to use the lower of the 2 going Fannie. That's where I get this number from. Second, net rental income or loss. They had a loss, so we have to hit them with that. That's where that number comes from. And then lastly, what percentage of ownership does he have? It's right here, it's 50%, and that goes here. All right, so this time we only did 1 year, we're not doing 2019. When you add these all together, you get to add this, this, and this all together. That's where this number comes out. And then you divide it over 12 months because we only did 1 year. This borrower's monthly income is $21,752.04. Does anybody have any questions on 1120S? All right, corporation or 1120. These are a little bit different because they don't have K-1s. So a lot of people don't think you need business returns because they don't have K-1s, but you do. So if you determine that, for instance, usually the only way we find out that they have a corporation is when their name is part of the business name and they get W-2 income, but they don't have K-1s, then you can assume that it's a corporation and you have to ask for the business returns. But the same rules apply, so 2 years tax returns, 2 years business returns, 2 years W-2s if the business returns report W-2 income, etc. Obviously for Fannie, 1 year if your AUS says it, and with Freddie again, 5 years if this date shows you that they've been incorporated for 5 years. And obviously year-to-date P&L and 3 months business bank statements. All right, so we're doing Freddie AUS. The business, as you can see, is less than 5 years, so that means we have to get 2 years returns. So this is the 1120, and again, make sure on the cash flow that you're using that it says Form 1120 and not 1120S because they're different. You're just going to follow the lines, so you're going to say taxable income line 30, which is down here, the 13612, total tax line 31. You have to hit them with that. As you see, there's a negative here and it turns red. You have to hit them with 2859. And again, these non-recurring gains and losses, if you see somewhere in the tax returns that they have non-recurring income, you definitely hit them with that, but you don't see that very often. Then depreciation, line 20. Nothing there. Depletion, line 21. Nothing there. And then amortization casualty loss. Again, that's going to be, on this one it says line 26, which is here, but again, that's a bunch of different deductions, so you have to go to the federal statements to see if you can add that back in. So we're going to go to the next part of the tax return. So again, mortgages, notes, bonds payable less than 1 year. This is Schedule L, line 17, column D. Schedule L, line 17. Column D, there's nothing there. Travel and entertainment, and 1, 5C, and there's nothing there. All right, amortization. This is the federal statements. As you can see, you don't see amortization listed there, so there's nothing that we can add back from that section. Now, with a corporation, they have to have that Form 1125E, which tells you how many people own the business. This one didn't have it, so I conditioned for that for this specific file. But since we're doing 2 years, we can go to 2019 and see if they have it to give us an estimation of what his percentage of ownership would be while we're waiting for the borrower to give us what we need. So this one is 2019. We're going to do the same thing. You go down to line 30. And it's negative 7872, you put that there. Line 31 is nothing. There's nothing here that's non-recurring. Go to depreciation, which is line 20. There's nothing there. Depletion, line 21, there's nothing there. And then that makes us go to amortization casualty loss, which is line 26. And again, we have to check the federal statements to see if it's listed there. Okay, so mortgages, notes, bonds payable less than 1 year, Schedule L, line 17, D. This one has it, 791,000. We have to hit them with that. So you put that in there, and then travel and entertainment exclusion, Schedule M1, line 5C, Schedule M1, line 5C, and there's nothing there. All right, so this is what we were looking for on the other return that they did have in the 2019. The 1125E, there are 2 owners. This is where it tells you the percentage of ownership, which is 50%, which is where you put down here. I put it for both years since we were waiting on the other year. And then, remember when using W-2 income to qualify, because that's what this is, you have to get the W-2. So we're going to assume this one is our borrower, 236,125, and if the W-2 has a lower amount, you have to use that. If this is lower, then you use this amount. All right, so here's the federal statements to check for amortization or casualty loss. And again, I don't see it here, so there's nothing that we can add back for this year, 2019. All right, so in this scenario, because of the large mortgages, notes, bonds payable in less than 1 year that they have, I would try and run this Fannie, because obviously this is in 2019, see if you can get a 1-year return. Or you could get a letter from the bank that states these will roll over year, and then you wouldn't have to hit them with this loss. So let's say that we got that letter, so we don't have to hit it with the loss anymore, so now I took it out. So now overall, 2019, if you see, shows a way better income than 2020, mainly because the borrower paid themselves a lot of money in W-2 income, but didn't pay themselves anything that I could see in 2020. When this happens, when there's a big loss like that from 2019 to 2020, we cannot use a 24-month average. You have to use the current year average. So when you go and you see them side by side, this is 2019 total income, but this is 2020. So I X'd out this year, just telling the form that I can't use it, and I take this amount by 12 months, and this borrower's total income that you can use is $448.04. So that's 1120 income. Does anybody have any questions on that?
What's a big loss? Like any loss or?
So any loss technically, yes. Even if it's a couple dollars, I always use the current year if it's less than 2019. Yeah. But I should say that if 2020 is a great year and 2019 wasn't the best, you have to use a 24-month average. You can't just cut out 2019 unless your AUS says you only have to use 1 year. So kind of stinks. Either you have to use the worst case scenario, either way. All right, so those are the different four different types of self-employed income. As you can see, it doesn't take long to actually calculate it if you know what to look for. And of all the business tax return pages, there's only like 4 or 5 that you really need to look at. So if you go through these screenshots, you'll know which pages you actually need to look at. And when we do our test case later, we only printed out the pages that you need to review to make it easy, so you can take that home and see the pages that you look for when you do it yourself. So now we're going to go over the P&Ls and how it relates to the business returns that we review. So one thing to note, you have to use the P&L within 60 days, as we said, and you have to determine if the current year is trending or declining or staying basically the same. If P&L is showing less income than the average that you're using, either the 1 year or 2 year based on your AUS, you have to use the P&L income to qualify. So let's say your 2020 average was $20,000 a month, but your P&L shows 17, I would use 17,000. Even though nothing's legitimate with P&L, that's what they require. However, it can't go the opposite way. If your P&L shows 28,000, but your 2020 returns show 20, I have to use 2020 returns. So in this scenario, it's an 1120S borrower, and we're only using a 1 year average of income. In 2020, their average income was $21,752.04, and our borrower is 50% owner of the business. So this is their P&L. P&Ls are super simple. Sometimes they're detailed like this, and sometimes the borrower just writes on a piece of paper, income 50,000, expenses 30,000, we can tell you to take that. So when you explain to your borrower, I need P&L, sometimes they get frustrated. They can make it really easy. It doesn't have to be intense like this. But this one shows all the income here, and then cost of goods sold, and then all of their expenses. So here's the bottom line, net income or loss. They have an income of $332,770, but that borrower is a 50% owner, so he doesn't get all of that, he only gets half of it. So after you times it by 50%, he gets $166,385, and then you divide that by the number of months the P&L is through. This one is through August. So you divide that number by 8 months, and that monthly income that he's averaging so far in 2021 is $20,798.13. So now, if you remember, the 2020 return told us he was making $21,752.04, but the P&L is showing less than that of $20,798.13. We have to use the lesser of. I would use the $20,798.13 to qualify. Okay.
I have a question.
Yes.
So if there's is it like if that's down like 25%, we can't use the income, or what percentage?
So that's a good question. So usually, depending on FHA, VA, conventional doesn't have specific requirements of how much it's dropping that you can't use it, okay? With conventional though, if it was a significant drop, luckily we now have the bank statements. You can prove that they are making that money. It's almost like us saying, well, I know it's dropped, but I can show that it's not a consistent drop because over 3 months they've made this much money and it supports P&L income. I've done that before. Now sometimes I have them explain why there was a drop. Right now it's easy, COVID, right? Most of our self-employed borrowers will say, well, with COVID I couldn't go out into the field, whatever their field is, and that's why 2020 was less, or you know, we had to get a PPP loan, you know, whatever it is. So they can explain a lot, and as long as we can show that it's now stable and they qualify with a lower number, we can still use it. Now with FHA, there's a little bit different because if there's a 20% decline over the analysis period, and that means 2019 to 2020 to 2021, it automatically becomes a manual underwrite, and that means we can't underwrite those in-house. It's sent to the investor. Not saying the investor still won't approve it, but it becomes manual underwrite because of the 20% decline. VA doesn't have that specific requirement, so VA is based on what the underwriter can determine. Okay. It's a good question.
Well, you know, when it's seasonal income, say they're doing one in the spring, but they make all their money in November.
Yep, another great question. I've had many that the P&Ls just are way low based on the type of income it is. And I've had them explain in great detail why that is. When do they normally get their big sales? Like, so it is seasonal, they say, let's say that it's March. Say you needed one from January 1st to March, but it's seasonal and it's Minnesota, right? I would say, can you get me last year's P&L around August to show your summer sales, and then also then explain why. I mean, obviously depending on if it's Minnesota, I get why they can't do a lot of sales in the winter if they are seasonal employees. But that's what I've done in the past, and then just a good explanation of why this year so far is low, but their big sales are coming up. And sometimes I've had people even put, I have about 30 expenses that are billed and not yet paid, and they will be coming in by the end of August. And then I've used that to supplement why the P&L can't be trusted in this scenario. So it can be done. You shouldn't ever knock it out just because the P&L is low, specifically in a seasonal type of job like that. So. Any other questions on that? All right, so business bank statements. Now this is obviously new. We've been reviewing P&Ls for a long time, but business bank statements with COVID, this is something different. So this is what we were taught when these first came out. And so if you ever see a condition from me or the other underwriters that say the business bank statements just do not support the income that we're using, we need more. I'm going to show you where we come up with that determination. So you need 3 months as of right now. And so for instance, our P&L that we just looked at is through August, so we would need June, July, and August business bank statements. Again, they would now be expired, but this is just an example. So with those business bank statements, if they go through August, our expiration date would be October 31st for the 2 months. All right, so it's pretty simple on how we look at these. Obviously with bank statements, I couldn't put the full one on here, there's way too much personal information, but what we did was to show you, you just take the beginning balance and ending balance to determine if there was any income that month. So, for instance, this one is June. Here's the ending balance. You take that 240,021 and 19 cents. You subtract the last beginning balance, the end of May, 381, 126.03, right here. And in June they had a big loss. Okay, so that's what I would calculate for June. And I'll explain this more in detail as we do the whole 3 months here. So July, ending balance is 265, 629.39. Last month ending balance, you subtract that from this, which is 240, 021.19. And that means in July they had income of 25,608.20. Then we look at August. Ending balance is 282, 336.67 minus 265, 629.39. So in August they had income of 16,737.28. So then we look at all 3 months put together. June had a big loss, July had positive, August had positive, so that's over the 3 months a negative of $98,759.36. So this is where I would ask you guys, I'm saying, hey, this borrower had this huge loss, over 3 months, it's showing a negative. We need to see if he paid himself any money out of those business accounts. Because as you know, just because it's in the business account with expenses doesn't mean that's how it works, right? If we can prove that they paid themselves, we can add those back in. So borrower provides 3 checks, which we would actually get copies of the checks showing that he paid himself money of $183,000 in June for second quarter distributions. So then you take that negative number from the 3 months, times it by 50%, because if you remember that this borrower is only a 50% owner, that equals this negative 49,379.68, and then you add in the distributions he paid himself of 183, and so that equals 133,620.32, which you would divide over 3 months. So those 3 months business bank statements that we got, the average monthly income was $44,540.11. So now, after we showed that he paid himself money, it does support the income that we used to qualify. It's not just checks that you could use. I've done, if we had personal bank statements in the account and I can see himself making transfers constantly to himself, I'll add all those back in. You can pretty much add anything back in that I can prove he paid himself for. Or, as I'm sure a lot of you know, if they're Schedule C, a lot of times they don't have separate business accounts, right? So that means all of their business money is going in, but they're paying their car loan, they're paying, paying their mortgage and all that. I, in that turn, would just look over and can tell that if I see all the bills from their credit report coming out of there, I would only then, on Schedule C borrowers, look at the actual deposits that they're making, and as long as the deposits that they're making, if they're using personal bank statements, are more than the income that we're using to qualify to account for possible expenses that they have, that's what I would use for a Schedule C borrower, if that makes sense. Does anybody have any questions on how we're looking at that? And I've also, too, just for instance, I've had a borrower prove that they also paid IRA big lump sums to other accounts that they have, not just personal distributions, but let's say that they're just saving for retirement. I've also added stuff like that back in. So there's a lot of stuff that we can add back in to make this work. It's very rare that I can make it work. Okay. So that is just how you calculate everything, how you determine what income you can use, and if their P&L and bank statements actually support it. So with FHA, you calculate everything the same. Nothing is different when it comes to that. However, the requirement for FHA is always going to be 2 years tax returns, and there's only one caveat to use less than that. So it says here that if the borrower has been self-employed between 1 and 2 years, we only can consider the income as effective income if the borrower was previously employed in the same line of work in which the borrower is self-employed, or a related occupation for at least 2 years. So what this means, I'll just give an example that I saw recently. Borrower was a nurse for 10 years, and then COVID hit and realized travel nursing was making a ton of money because of the shortage, right? They became a travel nurse. Well, travel nurses mostly are paid $10.99 because they keep being hired by different hospitals just for 8 weeks, 10 weeks, depending on what they're needed. So they turn into $10.99. You'd have to wait for all of, let's say they started that in 2020. They would need to have done that all of 2020 for us to be able to use it. But we could, if I can show that they were a nurse as their self-employed income, and they were a nurse previously for at least 2 years. So in that case, you could do it. Now, it does say that you have to show that the income was stable to increasing. So if they were making $100,000 as a W-2 nurse and now their self-employed income was only $70,000, then we wouldn't be able to use that income because it dropped. So it has to show that it's stable or increasing to use a 1 year FHA return. So with FHA2, you still need 2 years personal, 2 years business, and then also a P&L and a balance sheet. But a balance sheet isn't required on Schedule C, but a balance sheet is required in all the other types of self-employed income. You don't need business return or business statements for FHA. Does anybody have any questions on FHA? All right, so VA, They have pretty much the same requirements as FHA, except with FHA, as we talked about previously, if there's a 20% decline, it has to be manually underwritten. With VA, there is no requirement with that, but VA has the same protocol where you have to have 2 years of self-employed income unless they were previously employed as something that they just switched into a self-employed income. Same scenario, was a nurse, went to a contract nurse, and it's increasing. So VA is similar to FHA in that standpoint. You do need a balance sheet, you need P&L, 2 years. And a lot of with VA, it's underwriter discretion depending on if there's a loss or not, and if it's going up and down, if we can prove that it's stable. Again, there is no business bank statements needed